All right, this is Judith Paquette, and we are recording for May 14th. And I'm just looking at chapter 4. So what I was talking about, let's see, yeah, you can see. All right. Chapter 4 is a continuation of chapter 3. We do the PowerPoints in chapter 4. Chapter 3, there's 13 journal entries, and we're going to have that same company, Emerald City Graphic Design. We're going to have 7 adjusting journal entries that are built on the journal entries from chapter 3. And then we'll have 4 closing journal entries, same company, where we close the books. Right? So Callahan, you had a question about the interest adjusting journal entry, and I'm just gonna pull that chat over here. Okay. So there. So my advice to you guys, to all of you, whether you're listening live or whether you're watching the video, is make a flashcard. I'm really into the paper flashcards. Put the prompt on one side, the journal entry on the other, and just get comfortable with the accounts, and then also get comfortable with the calculations. So you're really learning 2 things. You're learning what accounts are in the adjusting journal entry, and then often there's a calculation you have to make for the adjusting journal entry. So there's 4 types of adjusting entries that are called prepaids, and there's 3 that are called accruals. Okay. And so why do we do any of this? So it's all about timing. Okay. So we're saying, I want to give you an income statement that says what happened in April. What were my total sales? What were my total expenses? And how did I end up with on April 30th with my balance sheet? How much cash, how much liabilities, etc. Okay. So looking at the income statement, we say we're going to use accrual accounting. Revenue has to be recognized when it is earned. If it was earned in April, it goes on the income statement. It doesn't have to match when the cash is received. And that's not how we do it for ourselves. You know, we say, how much did I earn last year? We're really saying, how much was I paid? But in corporate America, we say, what sale did you make? And then we'll sort out the when we're paid as a different activity. And then it's saying what expenses supported those sales. If they were in April, we record them. Okay. So if we were going to do cash accounting, we would just say it's revenue when the customer pays us. It's an expense when we pay the supplier, but we don't do that. We want to know what happened. So, all right. So we book entries. If we were a cash sale, we'd say that, but it doesn't have to be. It could be accounts receivable, and we still book it to sales revenue. So whether it's a cash sale or whether it's on credit, as far as accrual accounting is concerned, we book it to sales revenue and we count it to sales. Sometimes the customer prepays us. That's a debit to cash and a credit to unearned revenue. That's not a sale. Unearned revenue is a liability. And then expenses, we want expenses in the same period. And then I give you an example. I'm not going to go into that in the interest of time. You can watch that on the video. Okay. So here's the example on why we do accrual accounting. If a company buys supplies in October, on the beginning of the month, on October 3rd, but at the end of the month, they count the supplies and there's only 250 left, we have to adjust that supplies account. So in chapter 3, we said, oh, debit supplies, increase the asset supplies, credit cash or accounts payable. Now we're saying, now we need to adjust. Okay. So that's an example of when we need to make an adjusting entry. All right. So let's go to the adjusting journal entries. So there are a total of 4, 3 prepaid and 3 prepaid expense adjusting journal entries and 1 unearned revenue adjusting journal entries, and 3 examples of accrual adjusting entry: accrued revenue and accrued expenses. But since Callahan has the first question, I'm gonna jump to his question, okay? So before we do any adjusting journal entries, we look at the trial balance to see if anything needs to be adjusted. Elena, we'll talk about those. So I'm gonna start with accruals. See you later. Okay. I'm going to start with accruals. So the 4 prepaid adjusting account examples are these 4. And then I'm going to jump ahead from accruals because so accrual adjustments are different than prepaid adjustments. But all 7 adjusting journal entries will never, okay, how do I say this? Will either adjust a revenue account or an expense account. Okay, they'll either increase revenue or they'll increase expenses. So I'm going to jump ahead to accrued expenses. So what we say with accrued expenses is, all right, we booked the income statement, a preliminary, a draft, and we say, all right, right now, net income is $1,000, but have we recorded all the revenue we've earned? Have we recorded all the expenses we owe? Okay. So, did I miss that one? No, it's here. Let's skip salaries for now. Okay, here we go. All right, Emerald City. So this is the accrued interest. All right. So a company looks at its balance sheet and it sees that it has a note payable of $5,000. And the description for that transaction was Emerald City Designers signed a 3-month note payable for $5,000 on January 5th. The annual interest rate is really high in this problem. It's 12%. Okay. So $5,000 was borrowed, and we're just going to round up to the nearest month. We're going to say they borrowed it for the whole month. We don't have to go by day. So the monthly interest is going to be equal to the face value of the note, also called principal, times the annual interest rate divided by 1/12 because there's 12 months in a year. So the monthly interest is $50. Now, let's read this again. They sign a 3-month note payable. They will not be paying this note back until when? February, March, April 5th. Okay, 3 months. But every month that they borrow that money, they owe $50 on the note. And so when they publish the income statement for January, they have to recognize that they have this $50 expense called interest expense. So here's the adjusting journal entry. So in this case, you had to calculate the $50. And the journal entry is interest expense and debit. We're increasing expenses. That's going to lower net income when we increase expenses. And we're going to recognize that we have the company has a liability, interest payable, $50. Okay. Interest expense, interest payable. Right. So what have we accomplished here? We've said we need to properly reflect all the expenses in the month of January, and that includes $50 worth of interest. And we don't pay this in January. We're not going to pay it till April 5th when we pay back the note. But we need to start accruing the amount we owe. And that's the language we use. We're accruing the amount we owe. Okay. Does that help, Callahan?
Yeah, I think it just, since it's a 3-month, it kind of threw me off. I didn't know if we like changed the fraction or you do like multiple entries.
Right. And so you will. So at the end of February, you'll do this entry again for the month of February. And
Okay.
at the end of March, you'll do it again for the month of March. And so that interest payable will gradually, that T account will end up at the end of March with $150 balance. But you
Okay.
don't book the journal entry for the future. You only book it for the current month. And then in April, you turn around and you pay that note back plus the interest, $5,150. And you clear out the interest payable. And you clear out the note payable. So we're going to debit interest payable, debit note payable, and credit cash. But we're not doing that this chapter. We're just doing 1 month at a time. But I understand a lot of times students want to multiply it by 3, they want to, divide it by 3 or whatever, but it's 1 month at a time. Okay. All right. Okay, Yelena, let's go back to your question. Hmm. All right, so you want to go over the prepaids and then the accruals? Is that correct?
I'm just wondering if there's certain names, like for example, the 4 prepaid accounts are, advertising supplies, prepaid rent, equipment, and for example, I'm just reading it off of here, and unearned revenue, like what they are, because I'm trying to like organize it in my head what they are, and I've went through the PowerPoints and I'm just not getting it for some reason.
Sure. So these are 4 examples. So if you see prepaid rent, you could also see an adjusting journal entry for prepaid insurance. I don't show it because the process is similar. But if this had a balance here, it doesn't, it's got a 0 balance, you would treat it the same way. So we'll do a practice one on that. Any type of supplies account where you're just adjusting it monthly, you'd want that. Let's see, notes payable will be an accrual. And then so that's 5 really for prepaids. So, but prepaid rent, prepaid insurance are so similar that we don't, we treat them very similarly. So we'll do an example before you go. Are you here till 3:20 or do you have to leave early?
I'm here till 3:20.
Okay, so we'll do an example on prepaid rent and then we'll do an example on prepaid insurance. Okay. So things we buy ahead of time, supplies, insurance, could be prepaid advertising that's in the future. Definitely rent. You could buy a service contract on a equipment and use it up slowly, and then fixed assets. Okay. So the first example is supplies. You bought 1550 and now you only have 800. So a lot of these journal entries are similar to you on a Friday, any of you on a Friday, looking in your wallet and saying, oh, I have $5 in my wallet. I know you guys don't use cash, but let's just imagine. And saying, I'm going to go to the ATM and I'm going to get out $100. So you add $100 to your wallet. Now you have $105. Well, let's say Tuesday morning, you open your wallet and you have $20. And so you spent 105 minus 20 and that's what, $85 you spent. And then in your head, you're thinking, what did I spend it on? That's similar to how we treat the supplies account. We say we bought 1550 at the beginning of the month. Ending inventory is 800. So that's what should be on our T account is 800. So we have to make the adjusting entry to get that difference of 750 out of the supplies account. Okay. So here's the 1550. Am I sharing my screen? Please tell me I am. Yes, okay. Whew, okay. Here's my 1550. And I need it to be, this is my goal. I need it to be 800 because that's what I counted. That's my physical count. So I have to get 750 out of the supplies account because I know I used them. Okay. We're going to assume there was no theft or shoplifting or anything. So that means I used them up, debit supplies expense, and credit reduce the supplies account. Now those 2 accounts are really similar, but they're not similar at all. Supplies expense goes on the income statement. Supplies is on the balance sheet. It has a future value. It's like those 4,000 rolls of toilet paper you have at home from Costco. You haven't used them up yet. They have a future value to you. Okay. But we bought 1550 and we have to properly reflect what we have now, which is only 800. So now we say we're expensing 750 of supplies. That's going to reduce net income. It's going to go on the income statement. All right. So let's do, let's jump over here. Oops, I don't want you guys to see these grades. Hang on. And stop sharing. And let's go. Back to,
I have a question about recognizing revenue.
absolutely.
So
Yeah.
when we're adjusting entries, does that mean that we're recognizing revenue even before we're receiving the cash or the payment?
Absolutely. Yeah, Ariana.
Okay,
So
thank you. I
long
think that,
as the company has provided the service.
and in the case of unearned revenue, would we still record it before providing the service?
Unearned revenue, you would say, I got the cash, debit cash. I owe you the service. Like if you paid for an airline ticket, Alaska Airlines would say debit cash, credit unearned revenue. After you've flown, they'll make the adjusting entry. Reduce unearned revenue and increase service revenue.
Okay, thank you. And also, if a product was being delivered, would we have to record the revenue or the change of titles once it's successfully delivered to the customer? If
Yeah.
it's like a
Yep.
yes, okay.
Absolutely. Okay, I'm gonna share my screen. Let's do, can you guys see this? I want you to look at this.
Yes.
Number 7, it's a little small. The trial, and I'm still, okay, I'm still good. So the question is, the trial balance shows supplies at 1350 and 0 in the supplies expense. If 600 in supplies are on hand, that term on hand is a industry standard term. It means we went out and counted them. They are on hand. They are physically counted. This is what the trial balance needs to say. The T account for supplies needs to say. So what's the adjusting entry? A, B, C, or D? Direct message me in the chat. Yes, you got it. Okay. Ariana, you got it. How about the rest of you? Did you get it? So you start out with, I wish I could draw this. Let's see.
I have a question about this. So when they tell us that there's a starting amount or there's a starting amount of supplies, and then they go on to say that currently on hand, there's a fewer amount, does that mean that something is decreased in that case?
So think of your wallet. You had $100 in your wallet. And now on hand in your wallet, you have $20. 3 days later, you went Friday, you have $100 in your wallet, and now on hand, you have $20. So you know you spent $80, right? So that's what they're saying. So you have to balance to the $20. You have to balance to what's on hand.
Oh, okay, so in that case, we take like the initial balance and then the on-hand balance and subtract them from one another?
Correct, correct.
I think it's the wording that sometimes just
It
gets
is,
confusing for
you
me.
you have a ton of wording in accounting that you need to know. Can you see my Excel spreadsheet as well?
Not at the moment,
Okay.
just the problem 7.
Now can you?
Yes.
Okay. So visual, and I really, really like when people make T accounts. I think they really help students visually. So let's envision a T account here for supplies. So we're saying we started out at 1350, and you'll notice the problem isn't telling you debit or credit. It's assuming you know where the normal balance is by now. And then it's saying, hey, on hand at the end of the month is 600. So we're saying on hand, and this is pretty small. Can you see that? So therefore, give me the adjusting journal entry. Okay. So I've got 2 of you with correct answers. So you want to do what? Debit or credit supplies?
Credit.
So that eliminates all but C and D, which have supplies credited. And then it's just a question of saying, what do I have to do to 1350 to get to 600? And so like Ariana was saying, just subtract it. And sometimes it's more complicated than that. Maybe there's extra numbers. So you always want to go back and test it. But the correct answer is debit supplies expense, credit supplies.
Would they use the same wording if it increased instead of decreasing?
So that would be a different problem. So let's write a different problem. The trial balance shows 1350 if 600 supplies are on hand at the end of the period. And I'm going to add an and here. And during the month, the company purchased $400 more of supplies. What is your adjusting entry then? So what would you do then? Oh, sorry. No. Let's rewrite the whole problem. Doesn't matter. Okay. At the beginning of the month, the trial balance said 1350. And during the month, the company bought 400 more of supplies.
In that case, we would debit 400 and get a ending balance of 1,750.
So I'm going to have you guys wrap this. Okay. So at the beginning of the month, the trial balance. So let's write it out. Beginning of the month, bomb. And during the month, the company purchased 400 more of supplies. What would you do with the purchases? Debit or credit if they bought more supplies?
Debit.
Okay. And now at the end of the month, they counted 600. What would your adjusting journal entry be? Direct message me. Joanna, you are correct. And Ariana, yeah, so in that case, you'd have to make sure you took into account the additional increase. And that instead of being the end, so the difference in these 2 problems is in the textbook problem, it said at the end of the month, the trial balance said 1350. But now I changed the problem so that at the beginning of the month, the trial balance said 1350. So we have to add the activity during the month. All right. Okay, let's go back to these guys. All right. All right, so rent and insurance are going to be the same. So we're going to look at the rent example in the PowerPoint, and then we're going to look at a problem for insurance. Okay. Here, okay. So remember, in chapter 3, Emerald City prepaid for 4 months rent. Debit prepaid rent, credit cash. Now for all these prepaids, there's an original entry. Chapter 4 acknowledges the original entry, but it doesn't ask you to recreate it. It asks you to create the adjustment, okay? But it's always good to know the original entry, okay? Monthly rent is 1,100, okay? So now we've got to recognize at the end of the month that that prepaid rent has now been used up for 1 month. So we take the 1,100 out of the asset prepaid rent and we debit rent expense. Okay, how do we get the 1,100? We took the total amount, 4,400, and we divided it by 4 months rent. So let's do an example with insurance. Okay. So insurance. And on January 2nd, the company prepaid for 8 months of insurance, costing $8,000. I'm just going to use easy numbers. Make the adjusting entry as of January 31st. Okay. So you have the data you need, you know the total amount, you have the period of time. So, but this is a problem where you have to do the calculation the same way we did for rent, but now we're using insurance. Okay. So what is the adjusting journal entry? Put it in the chat if you know, or if you just know the dollar amount for the month of January, put that in the chat.
How much is the rent per month?
Can you see it? Maybe if you can't. You have to calculate it.
Okay, sorry, I got it.
No worries. So, Yelena, you got the dollar amount. What about the journal entry? What will that look like? So we want the adjusting journal entries, so there's no cash involved in adjusting journal entries. So let's go back and look at the adjusting journal entry for rent. So what are we trying to do? We're trying to show how much rent we've used up in the example. So we debit rent expense and we credit the asset. Because while it was in prepaid rent for 4 months, at the end of January, we've used one of those months up. So we take out 1,100 from the asset prepaid rent. And that reduces prepaid rent. And we increase an expense to show, hey, we incurred this expense. Okay. So it's going to be same logic with insurance. It's going to be insurance expense and prepaid insurance.
When it says that it expires each month, does that mean that the prepaid account credits even though we are making that payment?
That's such a good question. So this is the journal entry, Ariana, and it looks very similar to the rent one. We debit the expense account, but this time it's for insurance. We credit the prepaid account, but this time it's for insurance. So if you imagine a T account for insurance, in chapter 3, we paid it. Okay. There's prepaid insurance. I mean, we didn't do insurance in chapter 3, but we originally paid this and we debited prepaid insurance and we credited cash. And that was for 8 months. Now we're saying one of those months, 1 month of this 8,000 has expired, has been used up, has been consumed, all right? So we want to take out 1/8 of that because it's 8 months for the whole policy. So we're going to take out 1,000 here. We're going to credit prepaid insurance, and that's going to leave us with 7,000. Okay. And we're going to say, oh, there's 7,000 in prepaid insurance. How many months left on the policy? 7 months. That makes sense because it's $1,000 a month. Okay. So both of those methods, prepaid rent, prepaid insurance, the adjusting method is the same. You figure out the length of time and how much has expired or used up. So do any of you pay for car insurance? So I think you get to pay like 6 months in advance, something like that. Okay. All right, so back on the adjusting journal entries. The last one for the prepaids is depreciation. So depreciation means you bought a piece of equipment or a building. Land doesn't depreciate. And then you gradually write it off. So you say, so the question is, how long is the life of the equipment? Does it have any salvage value? And in this problem, we're just giving you the calculation, $85 a month. So this journal entry is different because it doesn't credit the equipment account. It credits accumulated depreciation. We track it separately from the equipment. So we debit depreciation expense, credit accumulated depreciation. And then here's how it looks. 5,600 is the original value in the equipment account. And then in a separate T account, we track accumulated depreciation. Why do we do that? Because we like knowing how keeping them separate tells us how far along we've depreciated. Accumulated depreciation keeps track. So if this number grows over 5 years or 10 years and it becomes $5,600, then we stop depreciating this asset because we've fully depreciated. If we stop using the asset, we write it off. If we're still using it, we leave it on our accounting records. And then finally, unearned revenue, we say, hey, Emerald City got a prepayment from a customer for some design work. Unearned revenue had a balance of 900. That was the prepayment that Joe's Grocery paid Emerald City. And now we see, oh, we provided 650 of service. So we reduce unearned revenue. It's a liability account. So we reduce liabilities with a debit. And now we're recognizing 650 of that revenue. So that's good. This is a good journal entry. It raises revenue. It doesn't increase expenses. Okay. All right. And then that's it for prepaids. And then the rest are the adjustments, the accruals rather. Okay. So accrued revenue. Oh, if Yelena has a question. Goodbye, Ariana. Yelena has a question. If equipment depreciated its full value, yes, if it's still being used. However, its net book value will be 0, but you'll still keep it on the books if it's still in use. If it's not, if you need to retire it, there's a journal entry to do that. You credit the equipment account, debit accumulated depreciation. Okay. All right, so accrued revenues is like, hey folks, have we billed everything? We want to get all the revenue for the month of April on our books. We want to make sure. And it doesn't require that you've actually sent a bill to a customer. So long as you perform the service, you can book the revenue. Okay. So Emerald City earned, and this is the language you'll see. Emerald City earned $2,300 for design services that had not been recorded. So you'll see that in your textbook, not recorded, not billed. In other words, you did the revenue, you did the service, you need to write the journal entry. So here's the journal entry. You learned how to do this in chapter 3, debit accounts receivable, credit service revenue. And that increases your overall revenues. So with these adjusting journal entries, often revenue is going up. And of course, accounts receivable goes up. And then the last one is the salary one, because we've already done the interest expense, interest payable. So the journal entry, let's go right to the journal entry. The journal entry is simple: salary, wage expense, salary, wages payable. Okay. So then you've got half the points there. You just have to figure out how much do we owe our employees as of the end of the month. So you want to read these questions very carefully. So if we say, hey, we paid our employees on Wednesday, the 29th. If they've worked the 30th of January and the 31st of January, we have to record that we owe that money to them, and we have to record that it's an expense. Salary, wage, expense, debit, salary, wages, payable, credit. But you usually have to do a calculation. So we say, hey, this employee gets $180 a day. He worked 2 days that haven't been recorded. So we want to put that on the books at $360. And there it is. Okay. So let's review these journal entries and see. So the final step is you run a new trial balance, and then note that the ending balances are different, but they do balance. And then you do the final income statement, retained earnings statement, and balance sheet. But I want to look at a summary of those. I'm trying to think if there's like a one-page or summary. Let's just do that. And I want to make a point on that. You should be able to see the Wiley textbook now. Let's see. I want to go to that page in here that shows a bunch of journal entries. You know, on top of that. No, let's close them. I want those. Bear with me. Here we go. Can you see this? 1, 2, 3, 4, 5, 6, 7. Can you see these journal entries?
Yes.
All right. Every single journal entry hits at least one income statement account and at least one balance sheet account. None of these journal entries hit the cash account.
Mm-hmm.
Okay. So first journal entry, which one hit income statement? Which one hit balance sheet?
The supplies expense would hit the income statement, and the supplies would hit the balance sheet.
Great. And on that first journal entry, did we increase net income or did we decrease net income?
It decreased,
Yes. How?
because the expenses went up.
Correct. Second journal entry.
Well, same thing, expenses went up, so.
Expenses went
we're
up,
making-
and that's an income statement account and a balance sheet account. Third journal entry.
Expenses went up, so income statement decreased.
Net income decreased, yeah. And then accumulated depreciation is also a balance sheet account. It is called a contra asset account because its normal balance is a credit. So contra means opposite. Fourth journal entry.
Unearned service revenue, that's a liability, and that went up. And that means our income statement went down.
Nope.
No?
Revenue was credited $400. So when we credit revenue, we increase revenue. So if revenue goes up, what happens to net income?
It goes up. Oh, okay, okay.
And then unearned service revenue here, that's a liability.
Mm-hmm.
We decrease a liability with a debit so that we can increase revenue.
So unearned service revenue is, so when it increases, it's credited, but it's debited, so it's decreased.
Correct.
Okay, oh my gosh, it's like the opposite.
Yeah, assets increase with debits, liabilities increase with credits. All right, you got three more, Elena. And I don't think we have time to do the accrual, the closing journal entries unless you really need it. Debit accounts receivable, credit service revenue. What categories are involved? What statements are involved?
Okay, so accounts receivable is balance sheet
Right?
and it's debited. And hold on. Which means your
So balance sheet doesn't touch income. So then,
the service revenue is credited, which means it goes down. That means the income statement is going down.
service, so if revenue is increased, revenue is increased with a credit.
No, it's increased with a debit.
No. So remember, they're on the right side of the equation, right? So assets are on the left side of the equation. Assets equals liabilities plus stockholders' equity plus revenue minus expense. So liabilities, stockholders' equity, and revenue are on the right side of the equation. They're increased with a credit. Credit has an R in it. They're on the right side. So we recognized revenue here. We recognized revenue here. So we increased revenue because we credited it. And that increased net income.
That increases our net income. Okay.
And then interest expense, interest payable, we debited interest expense because it's a minus in expenses, right? Even though it's on the right side of the equation, it's the opposite. So we increase expenses with a debit. So what did that do to net income? When expenses go up, what happens to net income?
It goes down.
Right. And same here, salary and wage expense, expenses go up. And it goes down, net income goes down. And then here we're saying we owe this money, we haven't paid it yet. We owe this money to our employees, we haven't paid it yet. None of those entries have cash in them. You know, we're just saying, we just want to make sure we have all the revenue and all the expenses in the current month that occurred in the current month. And that is accrual accounting. We just say, we need to know if we made money. And so we're gonna just say, we're gonna create an income statement for each month. And we can't be doing all this chasing cash. We need to know what we actually did in the month, regardless of where the cash is. That's the definition of accrual accounting. So mostly we're hitting expenses, expense, but we do hit some revenue accounts. Okay.
So for that last one, because the salaries and wages payable liability is increased, and the salaries and wages expense account is debited, that means our income statement is going, our net income is going down.
Correct. Yeah.
Okay.
Yeah, there's only two entries that increase net income, and that's when we hit sales service revenue. When we credit service revenue.
Okay.
But this is a good summary of the 7. And then when you get to the closing journal entries, we basically start with our trial balance and we say, let's get rid of all the revenue accounts, all the expense accounts, all the dividend accounts. We don't touch the assets and liability accounts. So this is the summary in your textbook, part 427. So normally, this closing journal entries are a little tricky because they're kind of the opposite of how you learned the normal balances. And so we say, hey, service revenue had a credit balance. We're going to write it off to 0, so we're going to debit it. All these individual expense accounts normally have debit balances, but now we're closing them, so we're crediting them.
But what happens to them when they're closed? Like, so if it's 10,600, that's initially credited on the service revenue. Once you're debiting it, it just doesn't make sense that you make it just go away.
You do make it go away because it's like your W-2. You want to start at the beginning of the year with 0 in sales, 0 in expenses. Because each year stands alone. And it's kind of
Oh.
funny that way, but it works. So let's see, looking at this one. This is right now, what I just said. Okay.
So on the service revenue, we're crediting income summary, but on the next entry, we're debiting income summary.
So we have 4 closing journal entries, 1 to close all the revenue accounts,
Uh-huh.
1 to close all the expense accounts. So let's go back to the trial balance before we make these adjustments. And then it's gonna be on page. Says it's on page 424. Where did it go? Here we go. Okay. So here's the trial balance before we adjust.
Mm-hmm.
All right, so everything in red are permanent accounts, so we don't touch those. But it's like right below retained earnings, everything below here has to go to 0. We have to start clean with the new year with no revenue, no expenses. So you can see service revenue has a credit balance here. And all these 6 expense accounts, including depreciation expense, have balances.
Mm-hmm.
And so our closing journal entry, we're gonna debit service revenue and think of those T accounts, make it go away. We're gonna debit service revenue, we're gonna credit all of these individual expense accounts. And we're gonna close dividends. Those are the 3 categories of accounts we close. And every year we start clean with a 0 balance in income, in revenue, expense, and dividends.
So
Mhm.
this is usually a yearly
Mhm.
cleanup, so to speak, not a monthly closing the books.
We do it monthly, but let's just, for this class, let's assume we do it yearly because we
Okay.
do annual accounting statements usually in this class, so yeah. So what I tell students is take your trial balance and draw a line under retained earnings and note after you've done your 4 closing journal entries and posted them to the T accounts, their ending balance should be 0. So we come down here to the closing entries and you can see debit service revenue, credit income summary, credit all these individual expense accounts, debit income summary. Okay.
Mm-hmm.
And then we say, well, what's going on in income summary? Well, income summary, let's see if I can, is there a T account? I don't think there is going to be a T account for me. No, okay, I'm going to make a T account here. Sorry for scrolling up and down. All right, so let's show a T account for income summary. Okay. So here we have these.
It's page 27.
Goodness, lost my page. No. No. What page is it on?
I think just a little bit higher. I think that's what, if you're looking for the journal.
This is what I'm looking for. Yes, okay, thank you, Yelena. All right. So let's book this. So the first transaction here. Let's say
Oh. Credit.
income summary 10,600. So income summary is a temporary account. We only use it for closing.
Uh-huh.
Second, and I'm not booking the rest. I'm just showing income summary. And then in the second journal entry, we have 7740.
Mm-hmm.
So your balance is what? Your balance is 2860, right? It's
Uh-huh.
So now we say this is actually net income. All right,
Income summary of retained earnings on the third entry is 2860.
right, but if you go back to page 23 for these same accounts, you will see,
Net income is 2860. Uh-huh.
you'll see that 2860 there. That's what you're doing. You're saying, make it go away. It's not gonna go anywhere, so here's your 10,600 revenue, here's all your expenses and the net income, okay? So that's what we've put into income summary. We've created a journal entry that actually shows, we will be creating a journal entry that actually shows net income. So let's go down to the closing entries. Now we're gonna close income summary, okay?
Uh-huh.
And it seems goofy. Why would we do that? It's just to create an audit trail. So now we're debiting income summary and we're putting those dollars into retained earnings. And you guys did this, and then now the ending balance here is 0, right?
Mm-hmm.
So, and then the last step is to close the dividends directly to retained earnings. All right, so the end result of this is we have taken retained earnings, increased it with net income, decreased it with dividends, and that gets us to the ending balance of retained earnings. So if we back up and look at the income statement, the retained earnings statement. In this example, the beginning balance was 0, but it could have had a beginning balance.
Mm-hmm.
Here we're adding net income, subtracting dividends, and that T account for retained earnings, its ending balance is going to be 2360. Because what did we do? We took retained earnings, beginning balance 0,
Mm-hmm.
credited retained earnings, that increased it, debited retained earnings for dividends, which decreased it, and that's the retained earnings ending balance.
Uh-huh.
That's the closing journal entries. We only do the closing journal entries once a year, but it's good to know how to do them. And let's see. And it shows down here how we, and it doesn't show beginning balance, but beginning balance of retained earnings because it's 0. And then you can see all these other accounts here have zeroed out with the closing entry.
Mm-hmm.
All right. So the key on closing journal entries is remembering after you book your closing entry, it's good to kind of do a few T accounts for revenue and expenses to make sure you didn't flip the journal entries. And then when you post your journal entry, it should zero out all of them except retained earnings.
Mm-hmm.
And then I'm going to stop recording.